Let's get things started here in the interest of time. I know everyone's probably on their lunch break or, taking a few minutes out of their day and tuning in with us, and we appreciate that a lot. Obviously here, everyone came here for a reason, and I think probably that's to learn and get smart about taxes, right? I think for most people, they hear the word taxes and some tune out. It's not the most fun language, but at the end of the day, we love it. And so we're here to try and simplify things and help you make better decisions about your future and really understand the asset class that we know and love. And thankfully, today we have here David Kleinhandler, CEO of Optifino, who spent, years in the life insurance space, grew and became very, very successful in that space. Michael Doniger, who came from the hedge fund world, exited L, ran his own hedge fund for years, and is bringing a very sophisticated financial approach to this platform. And a sophisticated approach that was really lacking from the industry altogether. And so we'll kind of walk through those details, but I think just to begin, we want to contextualize where we are, why are we having this conversation now with changing administrations. It seems like a very poignant time to embark on this debate and topic. And I'll pass it over to David to really explain why now, what's going on, and what are we seeing.
Yeah, Fabian, I appreciate the handoff. Gratitude and grateful to be able to present our thought process and share with you our wisdom and knowledge today. I want to start by asking a question. Let me ask you something that might keep you up at night. If you believe that 20 years from now, taxes are going to be higher than they are today, and there's compelling evidence they will be, then the problem I'm about to show you is only going to get worse and worse. Let's take a look at the current landscape of taxes. Historically, precedent shows income taxes as the government go-to revenue source. Currently, if you are in either California or New York, you're at a 37% federal rate, 13.3% in state. NIIT is 3.8%, and that equates to over 50%. High income earners are particularly vulnerable to this. Current tax brackets are going to go up. I know the administration is very favorable on taxes, but if we look at traditional retirement accounts could face much higher rates 20 years from now. Let me give you an example. Someone retiring in 2045 could face significantly higher taxes on their 401k withdrawals or IRAs than when they started saving 20 years hence. Let's discuss capital gains taxes, currently at historically favorable rates, likely target for increases due to inequality concerns, may affect real estate investments. It could dramatically impact your retirement portfolio from a planning perspective. Current estate taxes, you're looking at almost 13.6 million, and it sunsets in 2025. I doubt the sunset will happen, but I will share with you estate taxes have been eliminated 4 times and brought back 4 times. The last time was 2010, and we had George Steinbrenner, the famous New York Yankee owner, die then. Will transfer is definitely becoming a focal point for the political landscape. It may affect the middle class with appreciated assets. I believe the window of opportunity to do estate planning is potentially closing, but it will reopen. Let's talk about taxes. Taxes normally increase gradually, and then they increase substantially. The current national debt and spending patterns suggest inevitable increases. Currently, it's 37 trillion of deficit and 1.9 trillion of the current deficit. If we accept that taxes are going up, and history says yes, they will, you need to think about planning. You need to study, build tax diversification. You need to focus on your retirement exposures, The question isn't if taxes will increase, but when, and you'll be prepared. Fabs, let's go to the next slide, please.
Go ahead, sir. On mute. Let's talk about the importance of using these tax advantages for compounding money. You know, we love to reference Warren Buffett here, as we all do in the finance space.
Yeah, absolutely love Warren. My partner Mike talks about him a lot. I want to open up with a statement. Here's a truth that might surprise you. Market volatility isn't what's going to destroy your financial dreams. Taxes will. While markets recover, taxes are permanent. And right now, there are only a limited number of ways to protect your money from the growing tax burden. What I'm about to share could be the difference between retiring comfortably and watching your wealth slowly erode. Let's kind of take an example of someone who is going to invest money, 100,000 invested over 30 years, and really walk you through the tax advantages. If you invest 100,000 in 30 years at a taxable account at 35%, you end up with about 400,000 in 30 years. If you take that same example and put it in tax advantage growth with deferring of taxes or eliminating taxes, you're going to have over 700,000. This is why the wealthy stay wealthy. They understand tax advantage compounding. Let's talk about Warren Buffett for a minute. Warren's worth over $100 billion and pays less in taxes than his secretary. He takes minimal income. He borrows against his Berkshire Hathaway tax. He's deferring taxes through unrealized gains. This isn't about tax evasion. It's about legal tax avoidance. The ultra wealthy are smarter than they understand the rules better. That's the whole thought process. Let's look at how the government will look at things. They're going to start to study this from a point of what assets are unprotected. What are the targets? Traditional retirement plans, non-qualified investments. Assets protected by the IRS code section last to be affected. So when you think about this, you have to think about the viewpoint of let's understand how the codes work and use them to your advantage. I'm going to discuss tax advantage asset positioning, income stream diversification, strategic leverage, how the wealthy use these platforms to be able to make sure that they're not paying taxes. Because I'll go back to the one key point. Volatility isn't going to kill your dreams. It's taxes, because taxes are permanent. All right.
Yeah, I love that. Let's talk about the ways in which we can actually take advantage of the IRS code, and one that we think is the gift that keeps on giving.
No, that's appreciated, Fabs. Let me ask you a question that might change how you think about financial future. What if I told you one of the most powerful wealth building tool isn't an investment at all? Most people fundamentally misunderstand permanent life insurance. They think it's just about leaving money to their loved ones. But that's like saying a Swiss Army knife is just a blade. I'm going to show you why this might be the most versatile financial tool you are not using. Let's break down the misconceptions. The living benefit reality. Here's what most people miss. Permanent life insurance is for the living. Let's talk about key benefits. Tax-free wealth accumulation, accessible cash value during lifetime, credit protection in certain states. Think of it as a financial multi-tool that works for you while you are alive, not just for your beneficiaries when you're gone. The tax advantage fortress. Why do the wealthy, banks, and big corporations use life insurance? Because it's one of the few assets that's specifically protected by the codes, the IRS codes. Let's discuss the benefits. Tax-deferred growth, tax-free access to cash. In a world of rising taxes, this is one of the last remaining shelters. Let's kind of do a little deeper dive of what the multiple goals and the solutions are. College funding, supplemental retirement plan, business succession, estate mitigation, long-term care needs. It's not about choosing between goals. It's about having one tool that can help you accomplish them all. The question isn't whether you need life insurance, it's whether you are using it to its full potential. Most people don't realize they are missing out on all these benefits until it's too late. Let's explore how this tool might fit into your financial strategy.
Yeah, I love the point you make about how the wealthy use this, and I'm always astounded by the stat of how much of the U.S. assets sit on cash value life insurance, right? And let's talk a little bit about that for a second.
Yeah, this is really incredible. Wait, hold on one second. I apologize. Yeah, 16.1% of the U.S. consumer balance sheet is made up of cash value life insurance. I have a question for the audience. What do you think stocks comprise of the U.S. consumer balance sheet? Love to hear anyone guess. I'm going to pause for a second, take a sip of juice, and come back.
I think we can go ahead and reveal the answer.
Yeah, it's remarkable, Fabs. It's 21% of the U.S. balance sheet is made up of stocks. That's just
Remarkably close to the cash value.
Yeah, exactly. You know, it's really interesting. Let's look at some of the hidden truths. 54.3% of the U.S. assets are trapped in retirement accounts. There are key limitations: strict contribution limits, required minimum distribution, future tax uncertainty. Think about this. You're essentially letting the government decide when and how much your money you can access. Let's talk about the wealthy alternative: strategic tax insulation. We could build different structures customized for you based upon not having any of these limitations. No contribution limits, no RMDs, tax-free asset access, multi-generational wealth transfer. This isn't about avoiding taxes. It's about choosing when and how you pay them. Let's break down the numbers. Let's look at where the wealth really is held. Just go back to these stats because they're fascinating. 54.3% in retirement accounts, 21% in stocks, both taxable, 16.1% in life insurance, tax advantage. The wealthy understand this isn't about returns. It's what you keep. Every dollar in a tax advantage asset is worth approximately $1.35 in taxable accounts. Let's talk about the whole concept of the family bank, creating multi-generational wealth. How the wealthy use permanent life insurance, self-financing vehicles, family legacy tools, tax-efficient wealth transfer. This isn't just about a retirement. It's about creating a family financial dynasty. The wealthy start early because they understand time is the ultimate advantage. The best time to start thinking about this was yesterday. The second best time is today. Let's talk about how you can begin positioning your assets like the wealthy do.
Yeah. I mean, the family bank part, the concept is super powerful. I know we have a few examples we like to talk about and reference, but I think one thing to hone in on is these two historic brands that you see here in the back would not exist today if it were not for permanent life insurance. David, you want to walk us through kind of
Yeah,
their story? Yeah.
Yeah, this is one of my favorite topics to be candid with you. And this is what brought me into the life insurance world after learning these stories. In 1953, a man who walked into his 302nd bank meeting, for the 302nd time, he was told no. This man was Walt Disney. And what happened next would change entertainment history forever. Instead of giving up, he turned to a source of capital that generations of wealthy families had known about, but few talk about: his life insurance cash value. With $60,000 from his policy, he launched an empire. Today, I'm going to show you exactly how the wealthy access and use these powerful tools. A second example is our good friend Ray Kroc from McDonald's. Maybe this isn't a good example that he was able to tap his life insurance policy to open up 40,000 restaurants, because I know America's getting healthy. The Golden Arches would build on this strategy.
Yeah, and as a marketer, I know their famous initial campaign was actually funded by the life insurance, which is it's pretty crazy to think
Exactly.
about.
Some of the key things, and then I'm going to turn it over to my partner Mike and Fabs again. But banking on yourself isn't new. It's just not widely understood. The wealthy just don't use life insurance. They use it. They just don't own life insurance. They use it. It's not about death benefits. It's about living access. Your policy becomes your personal bank. At the end of the day, it's all about breaking down all the misconceptions. Mike's going to do a very thorough examination of some thoughts on different structures that are available to you. I'll turn it over to Fabian and Mike to take us from here, and I'll be back soon. I'm going to go drink some water again.
Thank you for that. There's a lot of powerful stories. Mike, we talk about one of the many strategies we can take, this among many others based on your goals, what's right. Walk us through this more risky approach that we're seeing here in front of us.
Yeah, thank you. Well, let's just take a second and build upon what David talked about. There was a lot there to unpack, but let's just imagine this for a second, and let's talk about some of the topics that David talked about, the different types of taxes that exist. You're in your 30s, you buy $100,000 of the market. If the last 60 years are any guide, that'd be worth around $8 million today, if you were 90. So think about what happens in that scenario. If you were to sell it, you have capital gains, as David referred to. If you die with it, you get a step up in basis, protecting the capital gains, but then you have an estate tax problem, which is anywhere between 40 or 50%. You would solve this problem first by gifting the money to your beneficiaries, to your kids in a trust. But even if that money grew inside the trust and then they were to sell it, they have a big capital gains problem again. How do we solve this? We solve this with permanent life insurance. We take this asset inside the trust, we wrap it in an insurance policy, it grows and grows and grows inside that insurance policy. And when they want access to that capital, family bank, they're going to borrow against that policy. Now that loan is somewhere like 0 to 1%. Why is it so low? It's your money. You're borrowing your money. It's coming out of circulation, but because the insurance company owns the asset now and not you, it doesn't trigger any capital gains tax. Eventually, many, 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 many years from now, when your heirs pass, the death benefit will kick in, which is tax-free if handled properly. It will pay off the loan, and then whatever's left over will go down to their eventual beneficiaries. This is the game, or not game, structures that people use, that the wealthy use to ultimately mitigate tax. So let's dive into a real world example. What I have up on the screen for you guys today is a male, 35 in good health. He's paying $15,000 a year for 30 years, i.e. until he's 65 and retires. And we're growing the assets at 8%. All right, so the first line on the top, the green line, is our benchmark. 8% compounded, not paying taxes, and that's what we're trying to achieve, which yields just under $4 million at age 75. If we were to wrap that in an asset, and in this case, we're going to call this variable universal life. And there's many, many, many different types of life policies, but I use this example because it is the purest way to think about market risk and market and compounding tax-free. So we take this VUL policy, we wrap our asset, we put the same $15,000 in over time, and we see in the end, we have about $3.2 million or 7.22% IRR, i.e., it costs us 78 basis points to protect this asset. Is that expensive or is that cheap? Well, let's just take a nominal tax rate of 25%, which is some function of buying and holding and trading and portfolio turn, et cetera. that would yield a 6% return. 8% times 1 minus 25, 6%. And we see over time that blue line drags and drags and drags, ultimately yielding 2.2 million. So in this case, we made over $1 million, almost 30% more over these 75 years by efficiently wrapping this asset in the VUL wrapper. So let's go to the next slide, Fab. Here's the trick. You may agree with everything I just said, but it's not that simple. There are carriers and subcarriers and subcarriers and new products getting innovated all the time, all day. Every quarter, we see new products hit the market. And then as Dave discussed, there's riders and long-term care benefits and a million different iterations or a million permutations when you start to think about that. So in the new age of all these products that exist, how can a human possibly decide what's right? How does this not become so overwhelming? So that's why we built Optifino. Optifino is an aggregator and a visualization tool that does real-time goal discovery with people like you. You interact with an agent, you can double click in, you can see costs, you can compare and contrast different carriers, noting that each carrier has a specific thing that they want to sell to a specific person, and making that match is how you find the ultimately best answer at the end of the day. Yeah, I think that's the idea.
Yeah.
And I'll pass it back to you, Fab.
Yeah, thank you. I mean, you said it right there. I think the market has gotten deeply more complicated over the last couple of decades. You know, you talk about, Mike, you've referenced the product war that goes on between these carriers to capture more and more niches. It's, you know, still remained until today very analog, and it requires more and more burden of these agents to really tailor the policies for their clients. I think, you know, our belief is that being so analog and not having the proper tailored policy has led to decreasing, you know, long-term satisfaction in those policies. And so, you know, we really want to create a step change and a disruption to that industry. And David, you know, from your experience in the life insurance industry, walk us through our platform, you know, how we are approaching it differently and kind of our beliefs behind that.
Yeah, Fabs, I really appreciate. Mike, thank you for a great overview. I think what's really important, and I want you to think of us as co-creators and collaborators. We want to understand and listen to your pain so we could figure out a solution best for you. I've spent the better part of 35 years studying this industry. We're not closing you, we're guiding you. We're holding your hand throughout this whole process. We want you to understand that we understand your pain. We will help you solve these pain points. And we want you to have an amazing, you know, retirement or legacy or however you want to view this asset class. But we take this very serious by guiding you through our principles. We have 2 ears and 1 mouth. We're going to ask you questions that are going to get you to understand where your pain is, and we're going to solve it for you. That's what's most important. Thank you.
Yeah, thank you. You know, if anybody has any questions that they would love answered, it looks like we might have one in the chat. If I can pull it open from the screen. Let me get out of this presenter mode and then go to Zoom.
I got it, Fab. How do you insulate yourself from the risk of a carrier failing?
Mike, I think that's a great question. And if you look at the banks, they're too big to fail. And there's also insurance on insurance. In the history of the annals of the life insurance industry, there's never been a carrier that has failed that hasn't been scooped up by other carriers. There's a whole pooling system. The last time this happened was with Mutual Benefit in the 90s. They were scooped up by MetLife. That, you know, life insurance is not going out of business. And if you look at the last, you know, with SVB and First Republic, everyone came out whole. So I believe it's the same philosophy in the life insurance industry as well.
Yeah, it's a great question. One other question. Let's see if there's any others. One other question that we often hear come up, and I think really inspired you to create this platform, David, is the thought that once you take out your life insurance policy, you don't have to think about it again. But that can quickly get you into hot water, especially 5, 10 years down the road, if your goals change or the policy's not performing as you expected. Talk us through a little bit about this belief of it being a set and forget asset.
Yeah, it's not a set and forget it asset class. You got to really study it. I actually would recommend reviewing it every year. A lot of people buy life insurance, put it in their drawers. They don't understand they're interest rate sensitive. They don't understand how the investments work. These are living, breathing organisms. Most people have an advisor that will place the policy, and then they do no aftercare. That's one of the measures that Optifino is really spending a lot of time on, to make sure the policy meets you where you are, your standards, and all of the above. And we do an annual review for you every year to make sure your policy always meets where you are. There's more questions in the box, guys.
Yeah, we got a couple more. We'll hit Satish first. I hope I'm pronouncing that correctly. He says he's 52 years old. Will VUL help me? Mike, you wanna answer that?
Yeah, now we're getting into some interesting questions. Okay.
How do you guys see the questions? I'm not even seeing. Oh, there they are.
In the Q&A,
Satish,
you got it.
absolutely, it will help you. It really depends on what your goals are, and that's what we do is goal discovery. 52 years old is definitely within the acceptable age to be buying insurance. You still have plenty of time to start compounding money over time. It really depends on the cadence and your health. If you are healthy, the cost of insurance should be somewhat reasonable. If you are on the lower end of the health spectrum, as you start to get older, the cost of insurance starts to get higher and higher. The earlier you do it, the better, but 52 is completely a fine time. We just have to do some goal discovery and see if we can get to where you are, which leads us right to the second question, the pros and cons of UL versus whole life. We talk about this on our blog, the spectrum of whole life, and I suggest maybe Fab, you can put it in the Q&A chat, right? But in the end of the day, whole life was the original product that was created by a lot of these carriers. And what whole life essentially was the carriers use their balance sheets, the money you put in, and they go out and buy bonds and real estate, and it's essentially a proxy for the BBB bond index. Whole life has a structured payment schedule, and you need to abide by that payment schedule, or else you might have to start to adjust it. Universal life got created, I don't know, David, you know better than me, but probably in the 80s or something like that.
Actually, E.F. Hutton in 1980s created the first iteration of universal life.
So what universal life was a different chassis where it said, listen, if you want flexible payments, if you want to go up, if you want to go down, and eventually if you want to guide how that capital is used. Originally, it was just put in straight bonds and interest rate sensitive vehicles, but the universal chassis was created. It sometimes was a little less expensive because it was managed with less actively managed, and it provided more flexibility. Universal life, that product doesn't really exist much anymore in its purest form. What has come on the back of universal life are products like variable universal life, index universal life, guaranteed universal life, things where you can use the universal chassis and start to buy assets that you decide how you want them to be versus the carrier deciding how they want them to be. I'll
Amazing.
stop there.
The
I'm going to
next
give this one to
question.
Dave. How do you borrow against and access assets, and can you compare interest rates of the family bank borrowing? Which I can do, or you can do, Dave.
You can go. I'll answer the next one, Mike.
Okay, so the way you borrow assets, it's actually super, super, super simple. Like imagine you have a Mass Mutual policy. You literally go onto the Mass Mutual site, you click borrow, and like 2 days later, or sometimes the same day, the capital ends into your account. In variable policies, they call it a watch loan, which generally means that they credit you and charge you about the same. Maybe there's 100 basis points of drag sometimes. And so you're borrowing money essentially around 0 to 1% in a variable policy. In a whole life policy, you're borrowing money at the difference between the net cost to you is the difference between the dividend they give you and what they charge you. Currently, the dividend is around 5-ish+%, I think. And the current borrowing rate on Mass Mutual is around 5.5 when I last looked. It's generally, right now it's cheaper than the banks. because it's usually a 3-year duration. That spread can be anywhere between negative 100, 200 sometimes, all the way to positive 400, like when we were in a very low interest rate environment and have a positive carry on that borrowing.
All right, the next question, I'm retired with a significant investment portfolio. I don't care about building generational wealth. I'm mainly concerned about tax exposure. Is there a viable strategy for someone like me? The answer is yes. What we would do is we would sit down and do goal discovery and then show you how different trusts work so you can insulate from the tax man. Bill Clinton, when he was president, it said it was the greatest gift ever given. So I would really kind of study that, and we could build models for you to show you how those work.
Yeah, I think to answer that question as well, we talk a lot about ways you can use it for supplemental retirement income. And so if you're not interested in building generational wealth and you want to use portions of that investment portfolio to retire or insulate and then use that to retire and have that extra income, there's a lot of ways in which we can help you do that. So definitely follow up and let's get a conversation scheduled. I think the next question from John is there a structure or strategy for the premiums paid to be tax deductible directly, or when the premiums are paid by a controlled entity?
Yeah, there are several techniques, Fabs, that we can use. You can buy life insurance in your pension plan. You can do what's called a pension rescue. These are more complicated strategies, but these are the things that we could help design for you. This is more of a bespoke offering, but we could talk offline if that's something of interest to you, John.
Amazing. I think these questions are pretty thrilling for us just because it means people are really thinking deeply about this in the conversation we had. I think with that we've gotten to answer all the questions, and we can wrap here and let everyone have some time back for their day. But we will be sending a follow-up email with this presentation. Please do get in touch and schedule some time with us, and we can talk through your goals and what that may look like and how to create a strategy. But otherwise, thank you for your time and hope you got as much out of this as we did.
Babs, let me just chime in for 1 second.
Definitely.
Look, this is something, we know taxes are going up. It's really crucial to start planning. We've spent a lot of time studying this over my career, and we would love an opportunity to sit with each and every one of you and take you through goal discovery and listen to your thoughts and concerns and help you build a plan that's going to be your fortress balance sheet. Thank you so much for your time, everyone.